Good morning and good afternoon to those of you on the East Coast. My name is Jason Rosenkrantz, and I'm a marketing director here at BackNine Insurance and Financial Services. Today, it is our pleasure to have Marty Krieger from Nationwide with us. Marty will be discussing the hot topic of the day and of the industry, which is long-term care. Nationwide has some unique features and benefits that other carriers are not able to offer, and Marty will be going over some of those unique situations and opportunities. Lastly, you will be muted for the remainder of the webinar, and everyone in attendance will receive a copy of the webinar after its conclusion. And with that being said, Marty, go ahead and take it away.
Great, thanks, Jason. Thanks, everybody. Happy, what are we, on a Wednesday today. Thank you for joining us. What I'm going to cover today is, in 30 minutes or less, is, I think, a huge opportunity that is in front of us, something that we at Nationwide have offered a long-term care solution for about 15 years, believe it or not. But really just the last 3-4 years, we've really started to get this topic out there, have it resonate with the client, and team up inside of a life insurance combination strategy, if you will. So what I'm going to do is go through this presentation and kind of point out some things. This presentation literally was written to go an hour plus. I have taken the liberty of making it shorter for today and have action steps for you to walk right out of here today and start having this discussion with your clients. I'm also assuming that maybe some of you already are involved in some type of long-term care planning, elder care planning in your businesses, but I'll give you kind of an idea and then some basics on the long-term care rider that we offer in our life insurance products. All right, so let's get started. Here's the opportunity. And again, this statistic could change in a number of articles that I see. But in general, between 8 and 10% of Americans have long-term care coverage. Or if we say it the other way, 90%, overwhelming majority of Americans do not have any type of formal long-term care coverage. The Affordable Health Care Act, or Obamacare, whatever you want to refer to that as, initially when that was coming out and they were drafting it, there was going to be some type of federal mandated or federally offered insured long-term care, and they decided to take it away from the final bill because the costs were just too high. And so everyone's just kind of left to insure themselves however they see fit. And you'll see I'll cover that more. But that would be one takeaway today, is just if you're not talking about or including a discussion of long-term care with your clients, you have a huge opportunity in that 90% don't have any type of coverage whatsoever. So why aren't people covered for most, or aren't covered for long-term care, rather? One might be the perception of long-term care. When I first started working with long-term care at Nationwide, I was thinking it was nursing home coverage. And that's really kind of incorrect, and as you'll see in a minute. But that's kind of the perception in the client's mind, is what we hear as we go and give presentations out to the field. It's nursing home coverage. Someone will take care of me. I'm not going to have to deal with that because it's not going to happen to me. So one thing you can start, one little bit of advice is, if you are starting this discussion, maybe avoid saying long-term care, and talk about more of ways to keep the client in their home longer, ways to have someone take care of your family members taking care of someone, and staying in the home as long as you can. That seems to be something that resonates, and you'll see that on the next slide. So when people look at this, they say, why don't I have it? I can afford, to pay for it myself, and there's some reasons why you probably don't want to do that. Or my family will take care of me. Or if it's a husband and wife, what we hear a lot is The husband doesn't think he'll ever need it because the wife will take care of him. Well, the wife takes care of him, but then she's going to need it too. And there's some interesting statistics as it relates to that. But it's one of those things where people don't want to pay into something, particularly traditional long-term care. Now, we do not offer traditional long-term care. We offer long-term care in a life insurance chassis. And again, there's some benefits there, as I'll get to. But one of the things that comes up is use it or lose it. When we couple it with a life insurance solution, there's never the use it or lose it objection that can come up, because you can answer that objection. Here's where claims start. And again, as I said earlier about nursing home, I thought, oh, it's nursing home coverage. Well, in reality, between 51 and 70% of all claims start out in the home. So when we talked earlier about, ways to keep you in your home the longest and have family members and so forth help with that care, because that's what they want. Plus improvements in technology, more and more folks want to stay in the home as long as possible. And look at there's some statistics here the Home Office put together. Claims are expected to quadruple in the next, 30 years, 20 years. And the length of the claim is increasing too. Typically the average claim, anywhere from 2 to 3 years, I used to say. Now the claims are starting to last a little bit longer. And then how about this? If someone is indeed in a nursing home, actually they have a 38% chance of perhaps going back to the home. So here's the whole home health care idea, or care provided in the home, or maybe even assisted living as opposed to a nursing home. Those are the majority of the claims, or those. What are the chances of needing long-term care? This is a stat that gets talked about a lot. And I say, anybody in this room, if I'm giving a presentation in front of a group of folks, anybody in this room at if you live to 65 or older, you have a 70% chance of needing long-term care. Pretty astounding stat, 70%. And then how about this? If you're married, or couples, domestic partners, what have you, if you're married, there's a 91% chance that one of you is going to need some type of formalized long-term care. But people sometimes, they don't realize it. They say, well, it's not going to be me, so there's a 0% chance. But look at the statistics. Between 70 and 91% between couples and single individuals 65 and older. We are seeing it in the younger market too, and I'll talk about that. So how do you pay for long-term care? And that's the million-dollar question. Some people just say, you know what? I'm gonna alter my lifestyle, and I'm not gonna get any insurance. And that's fine and dandy, but then assets start getting liquidated, or they're gonna rely on a spouse or family members, and that's a huge, huge issue today, is informal caregivers, family members taking care of a loved one. And I don't know if you think of your own situation, if you've ever been in that scenario. I have, taken care of my brother, and also my sisters and I took care of my mom at home, even though there was some folks coming over and taking care of her. That was part-time. The rest of the time, the family takes care of it. And then financially, there's a burden on the family members taking care of a loved one. So lifestyle is one way to pay for it. The other way is in just straight income. Dollar for dollar, you're just starting to spend down all your assets and use it for formalized care. Problem with that is then you don't have a legacy to pass on, because you're spending the assets during your lifetime. And then, of course, the solution I'm going to talk to you about is insurance. We know about life insurance leveraging a death benefit, right? When you buy life insurance for a certain premium, right, you've got a death benefit that is leveraging out your dollars. And the same thing with long-term care. We can add long-term care to a life policy, and now you've bought a bucket of money. That's really what you've done, a living benefit, if you will, to use in the event of a long-term care event, which I'll get to. Here's one stat I just wanted to throw in about what I said earlier about unpaid caregivers. The cost of an unpaid caregiver. Look at this one stat. It says the average unpaid caregiver is a middle-aged woman who also works full-time but is taking care of their spouse. On average, will lose in a lifetime, about $500,000 in lost wages and benefits. And what happens is, the longer the impairment goes, they end up quitting the job, loss of income. There's also emotional distress. So at least with some type of coverage with unpaid caregivers, at least you've got some financial assets coming in to help pay for their time. So how about this stat? 40% of senior caregivers end up dying before the person they're caring for. 40%. So there's some interesting stats. There's a website you could go to if you're really into this called caregiver.org, just caregiver.org, and there's a lot of stats on there about how many unpaid caregivers there are out there taking care of family members, friends, and the problems that are associated with that. Okay, let's stay on track here. The typical long-term care buyer is anywhere, and actually the age is starting to come down quite a bit. We've got the typical age we see is 64 and under now, and in fact with our life products we're starting to see long-term care offered to folks in their mid to upper 40s, and I'll talk a little bit more about that, particularly in our indexed universal life product. We're starting to see long-term care being offered to take care of that need. But typically, it's someone who's married, has some life insurance already, and ends up, has income probably, 100,000 or more, and these are numbers taken across the country. It's definitely going to vary, but someone that does have some income coming in and then have experienced challenges. That's the common ground you could find with your clients, is asking them, have they had an experience of taking care of a friend or a family member for long-term care needs or physical or rehabilitative needs. That's your key right there, is if you can get them to identify with that situation, they're more apt to look at some type of long-term care solution or adding it to a life policy product. And here are the reasons. Pretty basic. You like to protect your assets. Do you want to spend down your assets, or do you want to protect your assets? And here what we do is we talk about protecting assets. How about this? Being a burden on loved ones. The family members are always going to be involved in taking care of a parent, aunt, uncle, etc. But it's really the financial burden, the emotional burden, that starts to really play the longer it goes. And here's one: have a choice where care is received. Most folks want to stay in their home. How many want to go right to a nursing home? And if you were to ask a group of people, no, they want to stay in their home as long as possible. They'd rather pass away in their home through a hospice situation perhaps than they would being in a nursing home if they could prevent it. And be as independent as possible, and then again I just talked about being in the home. Okay, so let's now talk about, and we'll leave questions for the end, let's talk about this, about our long-term care rider at Nationwide, so that you can get a better understanding. So I'll kind of go through the basics, but essentially the long-term care rider is really a pool of money. And I'll give you an example. Let's say we did a death benefit of $500,000. We could buy a life insurance product for $500,000. We do a lot of our guaranteed universal life, or even, like I said earlier, our indexed universal life. So let's say we bought $500,000 of life insurance. We could also buy $500,000 of long-term care. And all we're doing is reserving that death benefit that would be paid out at death as a pool of money to be used in the event of a cognitive impairment, 2 of the 6 activities of daily living. I'll show you that in a minute. So essentially, all you're doing is adding on another option while they're living as opposed to dying. So some people say, oh, this is the new kind of insurance. You could realize benefits from your life insurance while you're alive. Well, it has to be for health reasons or long-term care reasons. So essentially, that's how our rider operates. You can guarantee the contract. If someone does go on claim, like in my example, if they went on claim, they could theoretically use up all the benefit. But they're never going to waste what they've purchased, either while they're alive or if they pass away. That's the key there. So that's our rider. We've had it about 15 years. Our rider is on probably 55%, the last number I've heard. 55% of all nationwide permanent products issued include long-term care. When I started with Nationwide almost 10 years ago, it was probably 3%. So remember I said earlier about the opportunity. We still have a long ways to go since only 10% have any long-term care coverage. But we're seeing it, again, 1 out of every 2 policies sold at Nationwide has long-term care. Here's an example of how ours works. This would be the hardest thing to learn about our product, I promise you, or about the rider, for those of you that don't know. And here's the example. Ours is a 2% rider, so you just remember 2%. So whatever amount of life insurance you buy, the monthly benefit is 2%. So here, we're buying $600,000 of long-term care. So forget my $500,000 example. Let's now think of $600,000 so we can stay with this chart. If someone goes on claim, we will offer up to $12,000 a month of long-term care benefits. But we have one issue in the way in order for the benefit to be tax-free. There's a safe harbor rule from Uncle Sam called HIPAA, Health Insurance Portability and Accountability Act. And it started kicking in one of the tax rule changes back in 2005 where the HIPAA started rolling out. And you hear about HIPAA a lot, like if you fill a prescription, privacy concerns. All that started way back when HIPAA was rolled out. But they also put some things in about how much long-term care would be possible tax-free. And more importantly with us, without any documentation. So with us, we go up to the HIPAA rate. And right now the HIPAA rate, it changes every year. This slide is showing 2015. The maximum daily rate for HIPAA is $340 per day. So on this slide where you see $330, for 2016 it's $340 or $10,400 a month. So that's the maximum that we will pay from our rider, from our product in 2016. In 2017, for instance, if it goes up $10 a day, then we'll be at $10,600 a month, and then the following year. So we could theoretically keep rising on the amount of the long-term care rider to match this example of $12,000. So the thing I want you to keep in mind is we're a 2% rider up to the HIPAA rate. 95% of the cases that I work on, and that we work with a lot at BackNine, usually don't go any higher than about $10,000 a month in long-term care benefits. You can buy more, and if the HIPAA rate does go up, the client will be able to access that. Like in this example, like I said, $12,000. But I think when we wrote this rider, we wanted to, way back 15 years ago, we wanted to stay and keep it simple so that the benefits are tax-free. We could talk more on this, but that would be the one thing I would leave you with is it's a 2% rider. The other thing I'll leave you with is what's covered. And a lot of these riders work the same. Ours is a true 7702 long-term care rider. You don't need to know about the tax code. Essentially, you can call it long-term care. I'll talk more about that in a minute because there's some other riders out there that a lot of carriers are starting to roll out, or they have. They're called chronic illness riders, and I'll speak to that in a minute. Ours is a true long-term care rider. So here's all the services we'll cover We'll also send you a long-term care client guide at the end. The client guide is a very good reference piece for you if you want to refer to what this rider is all about in about 12 pages or less, and it's also client approved. So the benefits are pretty simple. It's fairly comprehensive. It can be home health care, assisted living, nursing home, adult daycare, hospice, whatever the benefits are, we will cover it. Very comprehensive. The other thing I'll mention is it's indemnity style. And all that simply means is on that prior slide on the benefit, the 2%, let's say it's $9,900, or in 2016 it's $10,200. So, oops, I did not mean to do that. Sorry about that. I'm coming back to the slide. The thing to remember with us, we pay indemnity style, so if someone does go on claim, we do not require any other type of documentation to pay out. In that case, let's say it's $10,200 a month to the policy owner. Once you're on claim, there are no bills or long-term care receipts to submit. A lot of very popular options and a lot of traditional long-term care was a reimbursement style. And this is a competitive advantage for Nationwide, is that we are not reimbursement, we are indemnity, meaning we will pay the cash to the policy owner as long as they qualify for the claim. So in other words, whoever's taking care of a family member, whatnot, there's cash immediately, there's no ongoing bills and receipts to submit, and no monthly re-verification, et cetera, et cetera. That money can be used for any purposes. So for instance, let's say we have mom at home, she goes on claim, and there is a home health care service that comes 4 days a week. Let's say that expense is $3,000 a month. Mom could get $10,200, let's say. So the expense for the home health care services is $3,000 a month, let's say. The other $7,200 could be used, again, for family members to take care of mom on the weekends, expenses, upgrade the house, whatnot. So that's the difference in an indemnity versus a reimbursement. A reimbursement plan, you're not going to get paid $1 until you actually have a receipt that is a qualified long-term care expense. So just remember that this is more of a qualitative feature that would really hit home with the client who's purchasing it. Okay, how do you qualify? Cognitive impairment, that's Alzheimer's and dementia. Or quite simply, we talk a lot about 2 of the activities of daily living. Just what are those activities? Sometimes, a lot of people forget what they are, and they're listed right here: bathing, dressing, continence, eating, toileting, transferring. If 2 of those 6 cannot be done, then we get a licensed healthcare practitioner. It needs to be a U.S. licensed physician that will certify that, and we have an elimination period of 90 days. I won't get more into that because I'll run out of time. That's really how you qualify. Most true long-term care riders and chronic illness riders do cover, this is the triggering event for most long-term care benefits and features. Here's the other feature: we'll issue up to age 80. We can pay benefits outside of the U.S. if that's of any interest to you. We find that that's a competitive advantage for us. Say somebody buys the rider here, moves out of the U.S. in retirement, and they go on claim. We will pay the benefits outside of the U.S. in U.S. dollars as long as we can document, the same type of care as what they would get here, and we would need a U.S. licensed physician to certify that. The products available, or the riders available on all of our life products, we see it mostly on our guaranteed universal life. It's really the no-brainer product. You tell me how you want to pay for it: single premium, level pay, short pay, how long you want to guarantee it, and I'll run you the numbers. It's really that simple. I'll go through some examples in a minute. The long-term care rider, we can rate the rider. So with other carriers, it might be, they either accept it or they reject it. With us, we have a lot of flexibility on the long-term care rider, where we might be able to give them some long-term care coverage, but they might be rated, but at least you have some coverage and you can redesign the policy and custom design it for however it works. And there's a lapse protection feature so that if they go on claim, a lot of people say, well, does the client need to continue making their premium payments if they're on claim? And the answer is they don't have to, because we will never, ever lapse a policy with someone on long-term care claim. Even if they have no cash value and a premium is due, we'll never, ever lapse the policy. That's a huge benefit for someone worrying about this type of thing where they go on claim, their financial situation has changed. That's a safety net built in for them. Okay, let's go to the next slide. Here's quickly the differences between a long-term care rider, which is nationwide, and the chronic illness riders. I just wanted to put this in quickly to kind of make you aware, because if you don't see long-term care listed on a product that you're looking at, you might see chronic illness listed. Sometimes you'll see critical illness listed. It's not long-term care. And technically, you really can't call it long-term care. It has to fall under tax code 7702B. You don't need to worry about those kind of codes. Just kind of know that the long-term care rider, the one on the left side of your screen, will do everything a chronic illness rider will do on the right, but not vice versa. So a chronic illness rider won't do some of the things a long-term care rider, but a long-term care rider will do everything a chronic illness rider will do. And my example would be things like temporary claims. A long-term care rider will take care of somebody who, let's say, has hip replacement, knee replacement, where they're going to be out longer than 90 days. Remember, I said there's a 90-day event that needs to be met. Let's say they're going to be out for a year or 9 months. They could theoretically qualify for our rider and go on claim after 90 days and then come off claim, let's say after back surgery, for instance, sports injuries, mild stroke, where perhaps they're going to recover, function again, get back to work, etc. Maybe they're going to be out for a year. A long-term care rider will cover that where a chronic illness rider wouldn't. There's also things like residual death benefits. So if someone used all their long-term care money, we have a 10% residual death benefit. So in the example before of $600,000, let's say someone used it all up and is still alive, we would pay the beneficiary still $60,000 of death benefit, kind of a safety net, if you will. All right, let's move on because I'll run out of time. Where do you find the money for these to talk about? And a lot of areas I talk about, and maybe things that you're already doing, but looking at old annuity contracts is one where they had the money and they bought an annuity. They're not going to need it for income per se, for their immediate or retirement needs. They're just going to kind of pass it on and look at the growth. Those types of annuities could be looked at, and I'll show you an example, to fund a life product, either a level pay, a 10 pay. Remember I said earlier, you can really design this any way you want. You could do a single premium and have it contractually guaranteed to be paid up from day one. So annuities could be a source, not needed for income, I always say. What about folks that are in their 60s and above that have a lot of IRA and qualified plan monies? At some point when they retire, right, they're going to have to take distributions. So if you've got folks that are going to start looking at RMDs, you can have that conversation earlier and perhaps get them to start looking at taking distributions out. Yes, they're going to be taxable, but there's ways to run scenarios where that death benefit takes care of the taxes if they die with the IRA, and B, they have long-term care. Also, monies in the bank, CDs, things like that. I also mentioned, that's not on here, is older life insurance. Not the newer kind with long-term care. A lot of these in-force older types of life insurance products, maybe you could look at doing a policy review for the client. And, they bought the policy 10, 15 years ago. They have some cash value in it. Maybe they can look at 1035ing it over to something that's guaranteed, and by the way, give them true long-term care, which is a reason perhaps they didn't have. Generally speaking, policies that are, say older than 10 years probably don't have any type of living benefit riders attached to them. So I would put life insurance into this slide as well. So here's my quick 2 sales ideas, because I'm up to about 9:30 here. One is just a female 60. She bought an annuity a few years ago. She put $68,000 in, and now it's grown to $100,000, just to make it simple. And she doesn't really need it for income, worries about someone, her health issues and people taking care of her. If not, she wants to pass it on to her family. So we can do a 10-pay. We could annuitize it here. So we showed an immediate annuity, this $100,000 going into a SPIA, or immediate annuity contract, over 10 years. And it funds our guaranteed universal life product. Remember, I called that the no-brainer product. It's guaranteed. Her death benefit is $283,000, so she's almost tripled her value overnight if she were to die to the beneficiaries. And by the way, she's covered for long-term care claim, almost triple. And here's her monthly benefit, $5,600. That's just 2% of the death benefit, by the way. So that's one example. Another one is someone's got a CD, right? Well, what are you going to do with the CD? Well, I'm just going to hold on to it and pass it on to the kids. Well, remember, there's taxation involved. We assume there's a CD earning 3%, which I don't know where you can find a CD today earning 3%. But if this were to triple in value almost, I think they ran the numbers so that it would triple, she'd be over age 100. And remember, she'd have to pay taxes along the way, et cetera, et cetera. If she were to just do a single premium into life insurance, she's tripled her money overnight for her heirs, which would be tax-free as a death benefit. Plus, she's got $603,000 of long-term care benefit, and that's what did I say earlier? It's about $12,000 a month, or if she were to go and claim today, it's $10,200 with the HIPAA cap, like I said. But as you can see, what life insurance does, it provides leverage overnight. Younger folks now, remember I said earlier, we're selling a lot of indexed universal life, and we have a product that has guarantees on it called the Protector IUL. We have other products too that are indexed. We're just showing somebody in their 40s buying an indexed product for cash accumulation, and then we also run it with the long-term care rider. The give back in cash value is very, very minimal. I will assure you, if you run a scenario of where someone's funding a policy for cash accumulation, and you include the long-term care rider and then rerun it without the long-term care rider, and BackNine can help you with this, you'll see the difference in income and the difference in cash value might be maybe a 2 to 3% difference by putting the rider on or not including it. So I would always encourage you, look at including long-term care for younger clients in any scenario that you get into. We have an option on long-term on our second to die product now. This is brand new. We don't have it approved in California yet, but the second to die option is kind of unique, where we can do a policy on a husband and wife, and if they, instead of buying 2 policies, oops, sorry about that. Instead of buying 2 policies, they can buy one and save, about $4,000 or $5,000 in premium and get the exact same amount of long-term care coverage. So these are some things that you can work with Nationwide and your contact at BackNine, Jason, and really look at growing your practice. So with that, I'll end and open it up, if there are any questions, that is.
Marty, thank you very much for your time today. And does anybody have any questions at this time? I just wanted to thank everyone for attending, and I will be personally reaching out to each and every one of you to answer any additional questions you may have on the webinar today and see if there's any opportunities to work on some cases. Again, thank you for your time, and I will be speaking with you all shortly. Thank you.